Before its collapse, Silicon Valley Bank was not widely known. If you weren't in the world of startups, you probably hadn't heard of it, and you wouldn't have any reason to. The bank specialized in holding the money of and lending to startups and venture capital investors. You've probably heard of it now. Its sudden collapse is making front-page news and has caused unease around the world. From fearlessness to failure, what happened to SVB, and why are people concerned? Although SVB is a slightly different kind of bank than others, ultimately all happy banks are happy in the same way, and all unhappy banks are unhappy in the same way. SVB was a happy bank in 2021 because its deposits doubled amid a tech boom and the investment that followed. This meant it could do what banks do to make money: take deposits and make loans and investments with them. The bank makes money when the return on these is higher than the interest they pay to you, the depositor. They usually do that without much trouble, so the more deposits, the happier the bank. But as with all things in life, it's not quite that simple. Deposits are your money, also considered your asset, and so are the bank's liability. What's going on is that you and the depositors loan the bank money, and the bank promises you and the others that you can all withdraw your money or call back your loan at the same time. And that's the first piece of the puzzle. All the depositors can ask for all their money back at the same time. You may have heard that all the high-flying tech startups kept their money at SVB, and the fact that they, and tech generally, haven't been doing so well in 2022 means they started to draw down their bank accounts. For a while, SVB was able to sell enough of its assets to pay these depositors, and nobody paid much attention. But it's not that from one day to the next all the startups suddenly needed cash to keep the lights on, and this alone wasn't enough to cause too much of a headache for SVB. How SVB became a sad bank and then not a bank at all. As we just said, banks take your deposits and then turn around and invest them. So what did SVB invest in? It did make some risky loans to technology companies, but that's not the reason they failed. In simple terms, here's what went wrong. As deposits grew fast, SVB invested a lot in U.S. government bonds and also mortgage-backed securities. 40% of the bank's assets were in these investments, but they bought these when the interest rates were close to zero. As interest rates went up pretty rapidly over 2022, the value of those bonds fell. SVB became a sad bank when perfectly legal accounting stopped working for it. The Federal Reserve allows banks to calculate the value of their treasury bonds from two separate buckets. The first bucket is priced daily. The second bucket is marked as hold to maturity and doesn't get counted as decreasing or increasing in value. This is an oversimplification, but what essentially happened is that the bank had already sold all of its first bucket. It then had to sell its second bucket at their real price. The bank realized it didn't have quite enough after selling these bonds, so it had to go out to investors and ask for more money, what's called a recapitalization. The moment the depositors heard, read, or saw that SVB needed this injection of capital, they all panicked. They understood that they might not get their money back because 60% of it was in loans and other investments that aren't easy to sell quickly like treasuries are. So they all went to withdraw their money at the same time. But the depositors' money is locked up in complicated loans and other investments. The bank's simply not able to get all the money it owes to its depositors at once. So the bank fails. SVB got caught swimming with the wrong investments when the tide came in. This is why people are concerned. Remember, all unhappy banks are unhappy in the same way. Other banks may have similarly put too much money in investments marked in the second bucket of hold to maturity. SVB was the largest bank failure in the United States since that of Washington Mutual in 2008 during the financial crisis, and it came with little warning. And that only happened on Friday, March 10th. On Sunday, another rather large bank failed. Depositors are now scared that banks have lost too much money as interest rates have gone up to give them their money back. The way banks inherently work, though, means this is always the case. The problem with SVB is that it's reminded people this is the case. It sparked fear, and now everyone's a little nervous if their money is safe. It doesn't take many people to cause a panic. Only a small minority of the first people in line keep their money. You want to be the first one there. The prophecy becomes self-fulfilling. That doesn't mean there's going to be a lot of bank failures, but it is something to watch. Thanks for watching. Don't forget to subscribe. See you next week.